Good afternoon. Welcome to the Daily Rundown video. This is Mike from WIC. We'll just briefly touch on the market today, what's happening this week, and then we'll dive right into the very big surprise or news that we have in terms of sharing the trade that we just opened in Amazon. So today, we get news from the Biden administration that they reached a deal, a bipartisan deal on the infrastructure bill. As I've discussed in the monthly investor call last week, I was right that this eventually will happen. The Biden administration will be able to strike some deals. If not bipartisan, then they pass on their own. So the Dow was up about 300 points today. You can see on the intraday chart of the Dow, moved up huge after Biden announced that news. Of course, cyclicals are doing well when compared to the sell-off that they had last week. Also have big news today from the Federal Reserve. They are allowing banks to resume returning capitals to their shareholders after passing the stress test that the Federal Reserve put in place for the banks. So that's, of course, a big news for the financial sector. A lot of banks moved higher today after the news, but also the move was big to start the week with. We also are seeing continuing buying in the growth sector, and that also leads to why we're placing this very big bet in Amazon that I am going to discuss. So I'm going to turn off my video, I'm going to share screen and talk about this trade in Amazon. So you're looking at the chart of Amazon dating back from March of last year, the coronavirus crisis, until right now. So this was taken a couple days ago. You can see that Amazon moved up huge from March to September of last year, and then it did nothing from September until now. You can see a pole and then a flag pattern here. When this happens, and if Amazon can break out of the previous high, so that's about 3550 to above 3550 to above 3600, then the probability is high that Amazon will continue upside. And just based on the technicals of a bull flag, if that can occur, the target price is about $5,000 per share. We also look at a cup and handle formation that we can pick out from Amazon. Cup and handle is also bullish for the stock. It's based on this cup and handle pattern, the projected price, if the move succeeds, is to about 4,200 or so. Here's the next chart, comparing the performance of Amazon, which is in blue here, to S&P 500, which is in green. And then at the bottom in this orange chart, you're looking at the relative strength of Amazon compared to the S&P 500. You can see that the S&P 500 was on an orderly uptrend since March of last year, while Amazon moved up and then stopped moving. So of course, when you take a look at the comparison of the relative strength between Amazon and the S&P 500, it's going down. That relative strength index is going down, as you see here. Now, if you draw a line between all the peaks in that relative strength index of Amazon compared to the S&P 500, you have this downtrend, but it broke out like a couple weeks ago. So whenever there's a breakout from a downtrend, it signals uptrend is coming. Is it going to come all the way up to the top? We don't know, but that signals to us that the downtrend is over, at least for now. So that is another reason to be bullish on Amazon going to the months ahead. Here's another chart, but of a different stock. You can see a cup here and a handle. The cup started forming also in September of last year. This is, just to give it away, this is Adobe, another big cap stock, relatively comparable to Amazon. Adobe did nothing from September last year. It tried to make new highs back in May. So very similar to Amazon, tried to make new high back in May, pulled back a bit. Adobe pulled back a bit. But last week, Adobe broke out of the previous high and it's now shooting higher. So that's what we want Amazon to do, and that's why we're looking at Amazon, is because Adobe had a similar pattern and it broke out of that. Looking at the relative strength between Adobe and the S&P 500, very similar case. It can be made if you look at Adobe, so you can make the similar case to Amazon. It broke out of this downtrend and is moving up now. This moving up means Adobe is outperforming the S&P 500. You can see zero as kind of, if it's zero, then it's not, there's no difference. Now it's going higher, above zero to positive value. So because of this pattern in Adobe, we think Amazon will soon follow suit. And so let's discuss the trade that we can make in Amazon given this projection. Now, this is purely technical. Can technicals fail? Will it fail? Of course it can fail. So you just have to risk accordingly. Oops, I forgot to mention another piece of evidence for Amazon to kind of support the case for it to be for us to be bullish. There's the seasonality of the Amazon stock. So you can see in July usually performs well compared to the S&P 500. July performs well. Monthly averages for Amazon over the past 20 years, July 3.2%. The best performance is in November, about 8%. And the worst performance is February, down 5%. So July is a pretty good month. All right. An average return monthly versus the S&P 500. July is up there. Best is January, second best is April, and then July is, I guess, the third best. So pretty good cases for buying Amazon now. So how do we want to capture the upside in Amazon? We thought about doing this call butterfly spread. And so let's discuss what is involved here. You're buying one call at the strike price of $36.50 with the expiration on August 20th. You're selling simultaneously two calls at $38.50, dated 20th August as well, and you're lastly buying one call with the strike price of $40.50, dated 20th of August this year as well. So the cost to open this butterfly spread is about $2,500, depending on the market. The better price you can get, the better it is. The max loss you will have is just the cost to open this trade. So if all of your options expire worthless, then that's your max loss. And then the max profit that you can achieve is about $17,000. So let's just explain this trade kind of accordingly. So when Amazon goes above $36.50, this option is valid. You can buy 100 shares of Amazon at $36.50. What happens is if it goes to $38.50, then you will be able to sell it at $38.50. If it goes above $38.50, you will also you still have to sell it, but your profit coming off from the first leg, if you look at the chart price here on the x-axis, you can use the profit here to offset the loss that you may lose if you have to buy at a higher price and sell at $38.50. So maybe talking about the how this option works will take a little bit of time. So let's just take a look at the stock price versus the profit and loss. This is easier to understand. So you have 0 here. That means you didn't make any money. So you break even. You won't make or won't lose any money if the stock price of Amazon on August 20th is above about 36.80. So that about is depending on what was your cost to open this trade. So with the cost of 2,500, your break even is about 36.80. If it's below that, you lose money. The max loss you can lose is 2,500. That is when stock price is below 36.50. You look at the flip side, on the upside here, break even is about 40.20 on the stock price of Amazon. You lose max number, your max money, if it's 40.50 and above. You can see those are the strike prices of these buys. You make the most money if Amazon is exactly 38.50 on expiration, and going out to both sides, you start to make less. So that the shape, that's why you call it a butterfly spread. Next option, you could do what's called a call debit spread. This is easier. Essentially, you're buying one call with a strike price of 36.50 dated August this year, and then you're selling one call at 38.50 dated August 20th. The cost to open this trade is about 4,200. Max loss is just the cost that you paid, and then max profit that you can get is about $15,800. How does this work? If Amazon goes above 36.50, you start making money, although you have to account for this 4,200 that you paid at the beginning. So the stock price that you break even comes to about 36.90 to 3,700. What you're essentially doing here is you want to buy 100 shares at 36.50 and sell those 100 shares at 38.50. The difference between 36.50 and 38.50 is $200. 100 shares amount to be $20,000, and then the cost that it took for you to open this is 4,200, so 4,200. That makes your max profit to be 15,800. How does this compare to the previous trade? As you can see here, the cost to open this trade is higher compared to this trade. So the risk-reward ratio for this trade is better compared to this trade. But this trade amounts more risk because you only make the most money if the price is right here, right in the middle. If the price is over at both sides of the price axis, then you lose money. So the risk here arguably is higher than the risk here. In this trade, as long as the stock goes up, you make money, and you don't lose if stock goes higher than you're predicting. So that's the difference. Just think about the risk and reward ratio accordingly. And with that, thank you for watching, and we'll see you again in the next video.